Kia ora. I'm going to do a tutorial on cash flow statements. Okay, so it's the third main statement. Okay, there's an accounting standard to tell us all about it. But we're going to do the practical side of things now. How do we actually prepare one? Okay, so if we were given the set of accounts, profit and loss statement and the balance sheet, and plus any other sort of supporting information, we could produce a statement of cash flows. Okay, it's broken down into three main sections. Okay, that's the from operational, so we want to know what our operations are generating in cash. Is it positive or negative? Investment cash flow, so the buying and selling of capital items, fixed assets. That's typically in the, you find that in the assets section. You look for changes in fixed assets to pick those up. We pick up most of the figures we've got here for operations from the income statement, plus in the balance sheet the accrual items around expenses. And financial cash flow is money either drawn down as loans or raised as capital, or paying back the loan, or buying back the shares. So those are the financial types things. We look typically in the liability section of the balance sheet for those, and in the equity statement. All right. And finally, we do some reconciliations. We reconcile the cash flow statement to the bank balance and the balance sheet. And we also reconcile it to the profit and loss, as far as this is the trading profit, and this is how it relates to the cash we've received, right? So we'll cover that off today. Okay, so that's what we'll be doing. I just need to make it a bit smaller again. Okay, so there's the process. You'll get that process on the template when you're in your exam. The template you get in exam will be like this. Okay, we'll have a set of accounts. Okay, it will have other information, just different information, different numbers. Okay, it'll have the template for you to answer the format. So this is the cash flow forecast you'll have to complete. Okay, I might leave some it looks like I'll leave some formulas in there, right, rather so that you can, I'll be looking that you know what you're doing. Okay, all right, so you can see that's the cash per the balance sheet is there. So when we've completed this, that should equal that. Okay, and this is the one reconciling profit after tax to the net cash flow from operations. Okay, so those are the two main statements we want to fill in. But what I've got over to the right here are the workings. Okay, so we're just going to progress through them, and I'm going to do them in the order of this process. So the receipts from our customers. Okay, so what did we, at the beginning of the year, how much did people owe us? They owed us $580, okay, which I pick up from there. Okay, at the end of the year, how much did they owe us? Okay, at the end of the year, they owed us $740. Okay, so that's all pretty good. How much did we write off any bad debts? Because obviously that won't show in closing balance because it's been written off, but we didn't receive it. Okay, so there's a note down here, number 3, which says debtors of $80,000 previously provided for have been written off. Okay, so there's the $80,000. Okay, so it's $80,000 plus GST. Okay, because we're doing the accounts receivable, so it's $80,000, just the 80, because we're working in thousands, times 1.15 gives us 92. Okay. All right. What were our sales for the year, including GST? Right. So we're working including GST at this point. We break the GST out when we get down to the figure for the cash flow statement. So we know what our sales are. We pick that up from there. Okay. But we need to add the GST on. Times 1.15 gives us the GST inclusive figure. All right. Our ledger, we need to balance our ledger, and the balancing figure will be the amount of money you received. Okay. So we started with that amount. We made that amount of sales. That's great. Therefore, that gives us that figure that we could receive. But we've written off 92,000, including GST, and we've still got that amount we know showing in the balance sheet as owing to us. Okay, so therefore the difference is how much we actually did receive. Okay, so that figure will be the balancing figure. Okay, which will be the difference between these figures and that figure. That makes a balance, and that's the figure that including GST that we've made in sales. Okay, all right. For the cash flow statement, we want to recognise how much sales came in, excluding GST. We recognise the GST differently. It's a different item in the cash flow statement. So we need to now split that out from there. So it's those cash receipts divided by 1.15 brings us back down to the amount of money we received. Okay, so that's the amount of money from cash receipts. Next, we look to other payments, money going out, operational. Okay, employees. Okay, we look in the balance sheet and there's no accrual for employee entitlements or wages or payroll. So it's not as if we're accruing and there's nothing carried forward. So what we gather from that is that all wages have been paid in the current period. So that's a nice simple one. Really, that just equals what's actually in the P&L, which is, I'll see it in a sec, it's called wages, it's called salaries, okay? Good if they call it similar things, okay? All right, so that's that figure there, okay? What I'm going to do is, just to help me know what I've done, okay, is just tag some things, okay? Each to their own, but I find it useful for me to mark off what I've covered off. All right, that's good. The second thing is interest paid. Okay, it's the same thing going here. In the balance sheet, there's no accrued interest in either year, so there's no consideration of all the interest that is shown there must have been paid. Okay, it's nothing to do with the previous period, and it's got nothing to do with accruing something we haven't paid. So the interest again will be what's actually being paid. So it's that figure there. Okay, and that's the interest paid. Okay, again, I'm just going to use the same convention. I'm going to use the green shading for things that go in the operational side of things. Now we're moving down. Now there's a number of other suppliers, so we're just grouping these other suppliers together, right? We're not going to do them one at a time. Okay, so lease and rental, we know what that is. Okay, it's 168. Okay, I might, yep, it's 168, that's good. Right, it's rates and electricity, which is 90, which is good. Okay, so I've done those two. Okay, plus accrued expenses opening balance. Okay, so what did we accrue, which is a liability? Accrued expenses last year, okay, we accrued 27, okay, so we presume that we have paid that 27, okay, so we presume we've paid that 27, which is good, okay, and we obviously haven't, since that's sitting there as an accrual, we have not paid the accrued expenses at the end of the year, right? So I'll put that as a negative, okay? So that's those two done. Okay, so we've covered that off. All right. The next thing is payments to accounts payable. Right, so this takes a little bit more work. Okay, we can't just grab that figure easily. We need to have a little bit of a play here. So first of all, I go to accounts payable. I want to know how much we've paid our accounts payable people, right? And it's similar to what we did up here with accounts receivable. Right, what was the opening balance of our accounts payable? We owed, it's in the balance sheet, accounts payable is a liability. There it is. We paid that amount. Okay. What was the closing balance? The closing balance is 102, so it's dropped down. It's reduced. Okay. Okay. So we've got those two balances in, right? The next thing is how much did we purchase, all right? Okay. Even though that narration sort of tells us what the figure is. it's come from somewhere else. That narration was added afterwards, after we've sort of got the figure to help us. So we need to work out what our purchase is in, which requires us to look at how much we purchased. Okay, and we now need to look at the inventory, what's happened there, right? Okay, so what was our opening inventory balance? Okay, we can go to opening inventory balance, which is a current asset. Okay, we know what our closing inventory balance is, which is a yeah. Okay, right. So that's what we started with. That's how much we ended up with. Both these figures are both these started with, ended with. Both these inventories already excluding GST. All right. So what we want to know is how much worth of stuff did we sell? Okay, so this is the stuff that we sold, cost of goods sold, which is this one up here. And I'm going to have to, it's in minus in these accounts. Right, so I'm going to go, so it just shows up as a normal figure. I'm going to go minus, because a minus will turn it to a positive. Okay, right, so that's pretty much how we can populate these figures. So if that's what we started with, that's what we ended with, and that's how much we sold, the difference must be how much we purchased. Okay, so once again this has to balance. Okay, so that figure there will be that figure less these other two figures. That'll give us the difference. Somehow I've typed in something wrong here, right? Done a circular something or other. So that equals that figure. Oh, I know why. It's only minus that one. I don't know why I was minusing the total. That's better. Okay, so that tells us, cool, that marries that up with that figure there, that we've purchased 660,000 from that year. Okay, so that means that in accounts payable, we would have had purchases of that. Accounts payable is a GST inclusive ledger, so that's that. Okay, so 759. Okay, so that's the amount of purchases. So how much did we, how much payment to creditors, okay, will be okay. Okay, so this side needs to balance this, right? Okay, here we go. So basically, that's what we purchased. How much did we pay? Okay, so we must have paid off. We must have paid. Oops, wrong one. That one. Okay, we must have paid that, right? And this again brings us down, right? So let's just make sure I'm getting this right. Okay, so we have that's the amount we paid, but that's including GST. So we want to go what we paid less the GST. Okay, 756. And we're getting there. So 756 is the figure that goes there. All right, just populate that for you. So that equals that figure there. Okay, so we have to do a little bit of work to actually get to that. We need to look at accounts payable and inventory to work out how much we actually paid. All right, and therefore now those all add up, and that gives us the figure for payments to suppliers. So we've got the receipts, we've got payments to employees, interest, payments to suppliers. The next thing on the thing, D, 2D, okay, following it down here is income tax, and I've got a work paper for income tax. Okay, so to work out the amount we've paid for income tax, shall I just update the ones I've done here? Right, so we've done that. We've done cost of goods sold. Okay. Okay, that's just a formula, so we won't have to do anything with that. Doubtful debts isn't cash flow, that's not cash flow, that's not cash flow. Plant and equipment's depreciation, that's not cash flow. So really we've just about covered them all off. This is the one we're looking at next. So we're sort of ticking off all of the items in there, right? And doing that, we covered off inventory when it came to looking at who we'd paid. Okay, that was good, right? Okay, allowance for doubtful debts isn't cash, all right? So that's all good. We're doing well, okay? So the tax one, to work out the tax, we go, what was our opening balance of tax payable? Okay, opening balance of tax payable, which is an accrual in the balance sheet. So we should find tax payable as a liability, which it is there. That was the opening balance. Okay, and the closing balance is that one there. Okay, so that's our opening and closing balance. Okay. Okay, I dealt with accounts payable too when I did the payments from receipts, right? So this is just helping me tick things off in my head anyway. It shows me that I've still got to do something for GST. I can see the loans have moved too, and I can see equities moved. I can see also that buildings stayed the same. Land changed up here. Okay, I can see I'm getting ahead of myself a little bit here. Let's get back to income tax. Okay, so income tax, opening balance, closing balance. What is my tax expense? So that's how much I have accrued this year. So my tax expense this year is that amount. Okay, once again, I need to do it so it's not a minus down there. I'll just put a minus and minus, and that'll put it right. Okay, so the opening balance was that. The current year's balance, so therefore the total amount of tax would be 383. Okay, my closing balance only is 191 though. So obviously I've paid some tax. The amount of tax I've paid is that. Okay, that now balances. See the balance carried forward is the closing balance, it's correct. So I've paid 192,000 in tax. Okay, so that's another one ticked off. GST. Right, GST is the next one. Right, so what's happened in our GST account? Okay, what was the I've got a formula there, which is the L. Okay, what was the opening balance? Okay, so the opening balance of the amount of GST I owed was 7. What was the closing balance? It's got higher. Okay, so that's what's happened with the GST balance. Okay, so actually it's increased by 10,000, which is positive cash flow wise, if you get what I mean. So in other words, we've hung on to $10,000 that we will have to pay at some stage, but we've got it at the moment. Okay, so that's basically 10,000 in our favour, just in the change there. Okay, we're looking for the net thing in GST, not how much we paid and how much we received, okay, because they could be two big numbers. What we're looking for is just the difference, okay. Did we end up with a net refund or a net payment at, over all the GST periods for that there? Okay, at the end of the period we still owe 17, but we already owed 7 at the beginning, right? So okay, the next thing we look at is the changes in accounts receivable. Okay, so we've made the sale, but we actually have not received the GST yet. Okay, all right, so, or the sale, the sale plus the GST. So what was the opening balance of accounts receivable? It's up here somewhere. There's the opening balance. Okay, that's really good. What's the closing balance? Which is there. Okay. Okay. Now, what we've got to do is those figures are, so this is the change, right? So basically, sometimes I have to grab the right CLA. Somebody can show me how to do that better one day. Okay, so really what you can see there is that it's increased by 160. Right, so if it's increased, basically we're hanging on to, we haven't received $21,000 worth of GST. All right, okay, so that makes sense. Accounts payable, it's the same sort of setup here. What was the opening balance of accounts payable? Find that up here. Accounts payable is there. What was the closing balance? The closing balance 102. Okay, all right. So what's the movement? Okay, so it's actually decreased by 110. So we've actually received 14,000, and because of those expressed in that changes, we received 14. Okay. Right, it's not quite what I was thinking. Okay, opening, closing, decreases negative. Okay, increases negative, decreases negative. Okay, I think we've got something on its head here. Okay, we're going to come back to that in a sec. Okay, opening, that's right. I think that's right. It's increased positive. Okay, something has not quite worked out here. The way I've got another. I've got my worked example beside me here, and I know that's not right. It's supposed to be 25, so that's supposed to be plus 10. Okay, that's supposed to be plus 10. We'll go back to. I'll get to the right answer. Okay. And that's minus 14. Okay, which gives us the 25, right? Okay, so let's make sure I've got my head in the right thing. Increases negative, decreases negative. Okay, so that's right. Okay, so it's easy to get confused here, isn't it? That one's right. Okay. Yeah, because those are opposite to each other. Okay, and yeah, so that's positive because we're holding on to it. It's working in our favour. Okay. Right, now that makes sense. Right, so that's positive because we're getting to hang on to the money. Right, accounts receivable. These people, it's increased. what people owe us, therefore they haven't paid us the GST. Okay, their accounts payable, because we've paid more, the closing balance is lower. We've paid off about $100,000 worth of accounts payable, which is $14,000. So really, our net cash flow from GST is $25,000 out. Okay, so that's what we've got there. Okay, right. Cool. So we've done that. Now we're on to 3 and 4, which is investments. Okay, so we're looking at investments. Okay, and what the effect is with investments, right? We've covered off the tax, so that's done. That's good. Investments. So we're pretty much looking at the assets here, right? So we can see that land has changed in value, so we're going to have to do something with that. Okay. Choose the colour, Joe. That'll do. Buildings have stayed the same, so it doesn't look like anything's happened there. Plant and equipment has changed, so it looks like something's happened there. Okay, so it looks like we've acquired more land, looks like we've acquired more plant and equipment. Okay, so that's the main movers and shakers in that area there. Okay, so now if I go down to work paper for investments, land, it says what was the opening balance. Okay, the opening balance for land was that. Great. What was the closing balance? The closing balance was that. Okay, right. Okay, so for it to balance will be that figure there. Okay, so what we've actually outlaid on land is this figure here. That's excluding GST, right? Okay, 264. If we go to the notes, and this is just to, the question is just to really get us aware that, hey, look, we could acquire something for something apart from cash. And I'll put that note in there, I think. Buying fixed assets. Assets may be acquired for things other than cash. If so, this can be covered by a disclosure. Okay, all right. So if we read the notes here, additional information during the year ended. The first note, during the year ended March, land with a fair value of 264, which is what we found, was acquired by the company through issue of fully paid shares. So we gave them shares, right? So we gave them shares, so that's not cash, so nothing goes into the cash flow statement, but we would be aware that we've explained why that's moved, so we're good with that, right? We're good with why that's moved. We just make sure that there was a disclosure to cover that off, right? The next one is plant and equipment. We do exactly the same thing. Down to plant and equipment. What was the opening balance of plant and equipment? There it is there. We know it's increased, so how is it increased? There's the closing balance. We know it's increased by that. Okay. Let's have a look at the. Okay. So we've paid something for it, right? But we've also got to bear in mind, there's a note here. So we remember we did that bad debts. We've covered that off. All credit sales. Okay, that's good. Fourth is another note. Okay. So here's the last 4 and 5 is about plant. Plant costing $288, including GST, was purchased during the year. So we bought $288. And we got rid of some old stock at book value. It doesn't tell us what it is, so that's just created a bit of a little bit of a task for us to try and work it out. But we know we've bought some for $288 plus GST, and we've sold some. Okay, so we've got to find out how much we got for the one we sold, or it says book value, so we've got to work that out. Okay, how can we work it out? Let's go down to disposal, right? So we know that we bought for 288, 1, 2, 3, so that's all good, right? But let's just make sure it's only 288. Okay, so here we have it. We have our ledger that says we have opening balance, and we've bought that amount, so that we need to balance the ledger to that. So the difference between these two is what we disposed of. The cost value of that plant and equipment was what we've disposed of, right? So when we disposed it, that figure is going to be the difference between the two sides to balance it, which will be 240. Okay, so that means that we got 240 for it. So the journal is disposal fixed asset 240, which is good. Okay. Okay. Sorry, disposal of assets down here. So disposal of, wait a second. It is that one there. That is correct. Okay. Right, so in the disposal, and the other account was that. Okay. Accumulated depreciation, we need to work out what that is, right? Okay, because whatever that is goes covering off. So let's go through our accumulated depreciation. So we've got to work through about 3 ledgers here to try and solve that one. Okay, but it's all part of the sale. Okay, so what was the opening accumulated depreciation on plant and equipment? The opening accumulated depreciation on plant and equipment was 96. Okay, let's try and keep these figures. It's on the credit side already, so it doesn't need to be negative. The closing figure is the same for some reason. Okay, so that tells us something. All right, you normally see that increase, but because, okay, so there's the closing. Okay, that was the opening, that's the closing, but hey, we've claimed some this year. What did we claim this year? So this year on plant and equipment and the profit and loss, property depreciation is 168. Okay, so that is there equals 168. We go up here. There it is there. Okay, right, so if we open with that amount of accumulated depreciation, we've claimed that amount this year, you'd think the total was that, but we've obviously had to get rid of the depreciation, the accumulated depreciation on disposals of what was sold. Right, so the balancing figure will be 168, I'd say. Okay. So now we can work backwards. Now we know that that journal will need to reciprocate to here. So when we got rid of the disposal, we got rid of that. Okay. So this needs to balance. Okay. That was the cost. That was the accumulated depreciation. And what we sold it for was we sold it for book value, which is handy. Okay, so there's no gain or extra loss in sale. It's just what we sold it for book value. So the book value is going to be the difference between what the cost was and what we'd accumulated in depreciation, right? Okay, so now that balances and it's 72. Okay, so we've received 28 and we've paid out 72. Okay, I've actually got these cells down here populating already. I obviously didn't erase the formula, but the worksheet should be so you can pick it up. I should erase those formulas for the template you get in there because you could put the figures in anywhere. Okay, so the cash paid is that one. Okay, that's what we paid. So we're actually killing two birds with one stone here. We're doing 3 and 4. We paid that and we received that. Okay, cash paid for investments, cash paid for investments, cash from investments, paid for. Okay, have I got that? I've got that upside down. Plant and equipment is what we paid. Okay, is what we paid. And cash from investments is what we sold. Okay, cool. Right. Now, getting on there. Financing activities 5 and 6. Have we raised any loans or capital, or paid off any loans or paid off any capital? So let's look at the long-term loan. Okay, so the long-term loan is opening balance on the long-term loan is that. Okay, closing balance of the long-term loan is higher, so it's increased, right? Okay, so really what we've done is we've increased the amount of loan, right? Okay, so the cash drawn down, okay, is the difference between the two. So it's the difference between the two is 26,000. Okay, we've drawn down an extra 26. Cool. Right, that leads us to the last thing, capital. We know that because if I go through here, we're pretty happy with the P&L. We've done everything there. We've covered off everything in here pretty much. Okay. Okay. Then we're down to liabilities and debt. This is the equity section. Okay, so the equity section, choose a different color. Let's go for light blue. These two have had changes in them, right? Okay, we've already accounted for this one because you'll see that down here anyway. Okay,
it's 5 o'clock.
We've done the loan. We've done the loan, so that's covered. So the last thing is the capital, right? Okay, so if we look at the change in capital, so the capital is opening balance equals that figure there. Closing balance has gone up, so you probably remember why it's gone up, but let's explain it away. Okay, so the reason it's gone up by this figure here, and that is because we issued some capital for some land. Okay, and it should equal 264. Should equal what we paid for that land, 264 up here. Okay, so that's cool. The change in capital is no cash flow effect. Okay, so there's nothing to record there. Okay, so we've pretty much done all we need to do. Now we can just pick up these figures and post them, right? So the first one is receipts from customers. Okay, what's that formula picking up? It's picking up everything in this column over here. Okay, so receipts from customers is the first one I'm going to post. I'm just going to work down here. Okay, that's all good. Total receipts from customers. Cash was provided to 2A. We provided cash to our employees. Okay, we provided cash to the bank or whoever we're paying interest, and that's 2B. Okay, I should probably be entering these as minuses. Okay, so let's do those as minuses, so then my formula works better. Okay, we also paid our suppliers, which is 2C. Okay, so you can see by setting up a worksheet with references it certainly helps. Okay, then we've made payments for income tax, which is 2D. Okay, then we make payments for the change in GST, which is at 25. A bit round in circles on that one for a little while there. Okay, so that tells me that the cash flow from operations is positive $332,000. Okay, it's looking good. All right, cash flow from operations is there. Activities, operation activities. Cash flows from investments. So the note for 3 was 2, 3. Here it is. 3, 3 coming down. So that's cash from investments should be 72. I hope that's right. Why didn't that pick that up? Cash flow from plant and equipment. Have I got that blacked out or something? Okay. All right. That's all well and good. Don't know why that's a dollar sign and nothing else is. Let's just make it the same. Okay. That's positive. Cash was provided from, so that's positive. Cash was provided too. So what did we buy? We bought, so I'm going to put a minus in there because it's money going out. 288 were the plant and equipment. Okay, so yeah, I think my formula is just adding up this column. So rather than sort of having sub things over here, I'll just go on like this. So that equals 72. Okay. And that one is money going out for plant and equipment. Right. So cash flow from investments is negative 216,000, right? So hey, look, it's only going to be positive if you're selling more fixed assets than you're buying, right? So that's probably, in the general case of a growing business, normal cash flow positive from operations, cash flow negative from capital items, and then there's the cash flow from financing activities, okay? Cool. I should probably get a bit colour so we know where it is. So cash was drawn down from a loan. We know that it was drawn down here. Here's the loan figure. There it is there, 26. And that's pretty much it, I think. Again, I think I put that in that column there. But just make sure you check your formulas that everything's adding up correctly, right? Cash flow from, what's that say? E. Why is it not picking that up? E104 to 109. Yeah, should be picking that up, eh? Okay. Right. Let's make sure we've got this working. Yep, positive 26. Net movement in cash for the period. Okay, so that should be that plus that because it's a negative going out plus that. Okay, so 142,000 positive net flow, right? Doesn't reconcile to the thing. That's because what was our bank balance at the beginning? So that's the improvement in our bank balance since the beginning of the year. At the beginning of the year, we already had money in the bank, and how much did we have? We had 422, and hey presto, we now, this cash flow forecast, this cash flow statement, sorry, balances to the balance sheet. Great move. Okay, so that's that. The next thing we do is we reconcile the profit and loss and net cash flow from the operating activities. Okay, so what was our profit after tax? We go up here, profit after tax, get the right year, is that figure there. Add non-cash items, okay, depreciation, okay, because it's non-cash. We go all the way up here and where is it, depreciation, okay. It's more than depreciation though, eh? more than depreciation. The I'll come back to that in a sec. Okay, the add non-cash items depreciation. There's doubtful debts. There's a few of them there. Okay. Wait a second. Just quickly spin to this. Yeah, it's 22221. 221. Okay. Depreciation is in 2 lines. Okay, right. Add non-cash items 221 depreciation. That's good. Okay, yeah, that's fair enough. The other items we get cover off here. Add or take away deferrals or accruals. Okay, so there's things in expenses which has been accrued or whatever, so they don't relate, right? Okay, so the first one is accounts receivable. Okay, so again, you've got to get your head straight around these. Okay, as far as what's going to, what effect they're going to have. Okay, so increase and decrease in accounts receivable. Okay, so if accounts receivable increases, that means we haven't received all of the money from the sales, which is negative. Okay, so what we need to look at is the change in accounts receivable. Okay, which is opening less the closing, or closing less than the opening. Okay, I'm going to do it this way around. I'm going to do opening less the closing, accounts receivable, that minus that. So our accounts receivable has increased. Okay, so that means there's $160,000 worth of sales we have not received. Okay, so it's increased. Okay, so you just got to think it through. Okay, increase, decrease in allowance for doubtful debts. Okay, so again, if we've increased the doubtful debts, that's decreasing accounts receivable, right? So it works the opposite way around, right? So that one is, what's the change? Allowance for doubtful debts is in the balance sheet. Okay. Less doubtful debts. No, the change is okay. Accounts receivable. Okay. You can actually net those off and just do the change in the net, but I decided to split it out, right? Okay, but it's going to be worked out the same. Increase and decrease in inventory, right? So if we increase the inventory, it has a detrimental effect because we've got money locked up in the inventory rather than in the bank. Okay, so again, it'll be the opening minus the closing. So if we go to the inventory, okay. Somebody has arrived anyway. Accounts payable, okay. So with the accounts payable, again, what is the difference, okay? So accounts payable. Accounts payable, accounts payable. Okay, so we started off with more accounts payable. Decrease is positive. All right, so basically more people have paid us. That's a good move. Okay, accrued expenses. What's the change there? Okay, so accrued expenses have gone up. All right, which is a positive for us because that's expenses we haven't paid for yet. I'm just recording something here. I'm just recording, babe.
Are you talking to me?
Yeah, so yeah, it's all right. Increase is positive. Okay, so the tax is the same sort of thing. Are we sitting on more tax or less tax? Okay, tax has gone up as well, so there's 20,000 we haven't had to pay in tax yet. Okay, so that's positive as well. Okay. Right. So, I've obviously got something around the wrong way because otherwise that should add up properly. Okay. Right, so even in my rate thing, I have done something wrong. The the GST is changed by 10,000. Okay, so that's got it right. Okay, so yeah, my logic was wrong here. Okay, if we've decreased the accounts payable, we've paid off 100,000 more. Okay, that's why. So that's negative cash flow. Okay, so now that's the right way around. Okay, so I just missed out the GST, and I'd also just, my logic wasn't correct, right there, right? So you just need to sort of get this clear in your head, whether it's improving or decreasing, right? So now you see the net inflow from operation activities equals the net cash inflow from operation as per the statement. Okay. Right, I will tee off now. Okay, next tutorial will be on preparation of financial statements.